welcome back to the Property Trio, the podcast for the sophisticated property buyer. I'm your host, Cate Bakos, and as always, I'm joined by my good friends and co-hosts, David Johnston and Mike Mortlock. How are you both?
G'day.
Very well, thanks, Cate.
I'm looking forward to this one. It's a juicy one, and you prepared it, Dave. I love it. So I hope our listeners feel the same. We've got a wonderful listener question, but we've really structured today's ep around the guts of his question, which is the truth behind unlimited borrowing capacity through multiple trust structures. And I've heard this and read it so many times and always thought, oh, I'd love to unpack it. And Dave, you've done it.
Yeah, I'm surprised it's actually taken us 300 odd episodes. I should have thought of this one earlier. Thanks to Jeromy for sending in the question.
Yeah, well, Jeromy, we are very grateful. And I'm going to read your question out to us. Well, I'm a long-time listener and I'm very grateful for all the sensible, measured guidance you've provided over the years, which has helped me build a portfolio of several properties without overextending myself. Got to tell you, Dave and Mike, that makes me feel so happy just reading that first para. I recently had a conversation with a friend who's looking into a strategy being promoted by some buyers advocates and property spruikers, which claims you can achieve essentially unlimited borrowing capacity by setting up multiple trust structures and with each trust holding one property and its own debt, supposedly allowing you to keep resetting your borrowing capacity with each purchase. Something about this doesn't sit right with me though, and having learned so much from your podcast about prudent lending, risk management and the importance of serviceability, I wanted to run it past you. Could you share your thoughts on the risks and realities of this approach and why buyers should be cautious about claims of unlimited borrowing capacity through trusts? Now, I want to acknowledge that Jeremy's not only listened to our podcast, he's also worked with Dave's team in property planning, selection and mortgage broking, as well as with myself for buyers advocacy. So, Jeromy, it's a great question.
Come on, Jeromy.
You know what?
I think
he has. I think he has. We certainly would have mentioned the importance of quantity surveying. It's in our documentation.
Love his work.
So
you might have even met Jeromy at the 20-year PPA party.
Yes,
oh, yeah, right.
You might have. So, Jeromy, it's great to hear from you. And it's thoughtful of you to think of your friend in this situation and reach out and run it past us. So, Dave, I'm going to start with you. I'll throw this one straight to you. Can you walk us through how this strategy is meant to work in theory?
Yeah, I'd love to, Cate. So, look, on paper, this sounds great in theory and is the type of idea that does capture a lot of people, you know, through the social media marketing and those kinds of things, and has for as long as I can remember before social media even existed. You know, this concept that you buy a property under a trust structure and, you know, as the property increases in value, you then release the equity to help fund the next purchase, ideally, which sits under its own trust. And, you know, in theory, you've got multiple entities. Trust A owns property A, Trust B owns property B, and each one has its own loan potential, you know, in theory. You know, that's the claim, even though you're accessing equity from the first one. So it's actually already there's a flaw in the idea right from the start. But, you know, the claim is that because the loans are in separate entities, your borrowing capacity starts fresh each time and you can keep repeating this process indefinitely and just buy as many properties as you want to.
I can see that you've got your fun police hat on today, Dave, because I mean, like, this is like what a draw card for investors. A theory that, you know, it's sold a way to build a portfolio faster with unlimited capacity and supposedly reduce risk because each property is isolated within its own entity. I mean, like, I want this to be true, Dave, please.
Yeah.
Don't we all?
On paper.
And Annabelle wants a unicorn for Christmas too.
Well, let's keep going down this path. On paper, each trust is like a little island. Separate loan, separate property, separate risk, and separate borrowing capacity. It does sound neat and tidy.
Yeah, it sure does. But, and it's a big but, that's only how it looks structurally. In reality, lenders don't assess these entities in isolation because you are the common link. You're the guarantor. every loan still comes back to your personal capacity to service the debt.
And that's where, unfortunately, we have to come crashing back to earth, because you can't just keep adding trust after trust after trust and hope the bank stops counting your existing loans, because eventually they will follow the breadcrumbs.
Yeah, well, let's dig into that a bit deeper. Dave, what's the practical hurdle investors run into when they try this strategy?
Yeah, well, so, you need someone to be a guarantor or a trustee of the trust. Often that's a company. So if you're the trustee or the director of the company that's trustee, that comes up when they do a credit check on you. Okay, so then the lender will ask for copies of all the tax returns because you're the common theme of ownership of these trusts, and so they all then feed into your serviceability calculator, and that's the biggest challenge will be serviceability, which is your ability to actually afford the repayments once you've released the equity and added more debt. For this strategy to work in reality, each property within its trust needs to be strongly positively geared. That's because most lenders won't count 100% of your rental income. They'll typically shade it to around 80%, let's say, of the rental income to allow for vacancies and the expenses. As most people would know, they also build a repayment buffer to cover for potential interest rate rises, which is generally, 2.5%, 3% above the rate you're actually paying. And to make things even tighter from a borrowing capacity perspective, interest rates for trust loans are often a bit higher than the rates you'd get borrowing in your own personal name, and so are the fees. So really the rent has to do a lot of the heavy lifting, and that takes time. Even if it starts just neutrally geared, that's not enough. It needs to be significantly positively geared to get positive serviceability. It needs to cover not only interest, but also property management fees, insurance, land tax, accounting costs, and that buffer amount that lenders apply when stress testing your loan.
I'm really nervous about this because we know the relationship between capital growth and rental yield. They don't generally go hand in hand unless you're introducing high risk. So relying on this strategy, if you can find and amass a portfolio of enough positively yielding properties, you might be able to pull it off. But then what is your capital growth? And we're not thinking about long-term maintenance here at all.
And if they're shading the rent, even going regional NT, which always pops up in our monthly update as the best yielding location in Australia, it's still probably not enough if you're buying, an investment property that has capital growth fundamentals to be positively geared out of the gate. So you're really kind of restricted to a very modest LVR. So it is, I suppose, on paper, it's doable, but the question was about it being sold, sold by property investors, sold by, buyers agents or property spruikers. That's where the kind of problem happens. And I actually am a registered tax agent, but as part of the conditions of my registration, I'm not even allowed to talk about it. So I would argue say that I would be more qualified than your average buyer's agent to talk about it, but I won't because it's not my area of expertise. And I think that is a big problem for the industry.
The other thing that's a really big problem here that makes me nervous that I've seen is over the long term is if there's a group selling strategies like this, they're really aggressive with the investment strategy. And so the worst case outcome that often happens is people are buying multiple properties too fast and they're highly leveraged, and then their cash flow is really tight. They're really stressed out. You often meet with them after the fact and they've bought multiple properties. They're leveraged above 80% often. They haven't had much capital growth. They can't sleep at night because they have more expenses going out than money coming in including their income. And so then they're trying to unwind these things. And then the cost to exit, when you add up the cost to get in, they've often lost money, and it's just been a really stressful situation. And that's often the outcome.
Yeah, I don't disagree at all, Dave. I've seen that many examples of this, and it's very difficult when people think that they're acquiring all of these properties and they're focusing on the number of properties rather than the quality of the properties. But the toughest one is when the maintenance starts to roll in. And we all know that doesn't happen in the first few years unless you've bought something that really has some issues. The serious maintenance is usually at the 10-year mark when you've got to put in a new kitchen or a new bathroom or whatever it might be. If you haven't had that capital growth, you'll be looking at it thinking, what's the point? And that's an issue when it's across multiple properties.
Yeah. And let's not forget, maintaining multiple trusts adds extra costs as well. I mean, you're paying setup fees, annual accounting, compliance, it all eats into the cash flow.
Yeah.
And, so unless you're starting with really high deposits so you can reduce the loan amount and or repayments or exceptional yields, the numbers just don't stack up.
It sounds like accountants might love this, or some anyway.
Yeah, I mean, often with these types of ideas, you have a team. There's the lawyers, there's the accountants, there's the often property developers, and often there'll be mortgage brokers involved. You may even have financial planners involved.
Yes. Yep. Absolutely. Well, it leads me to the next question. From a lending perspective, even if each trust looks self-contained, the bank still looks at you as a common thread. Let's delve into that further, Dave.
Yeah, so as we've sort of alluded to already, most lenders factor in personal guarantees. So the bank aggregates all your liabilities anyway, whether they're in personal names, whether they're in certain trust or company names that you are a director or trustee of. If you have a spouse, it's all aggregated. So the reset effect is essentially a myth. There's no magic loophole that lets you outsmart lender credit policies, and to some degree you don't want that to be the case because they're there for a reason to help you manage your own risk when it comes to how much you borrow.
Fun police. What?
Sometimes they can be too strict. There's no doubt about that, Mike. That's why you use a good strategic mortgage broker who can just artfully, put together a submission that maximizes your borrowing capacity. That's affordable.
Yeah, true. Well, let's talk about land tax. Dave, you touched on this before, and it's something a lot of investors overlook when they're considering buying in a trust.
Yeah, so land tax is one of those hidden costs that can really change the numbers for people who are buying in trust structures. In several states, and Victoria is one of them, trusts don't receive the standard land tax threshold that individuals do. So currently in Victoria, individuals benefit from a tax-free land tax threshold of $50,000. So there's no land tax for the first $50,000. The fun police of our state recently reduced that from $300,000 and it down to $50,000. So while trusts begin to pay land tax once their taxable land value reaches just $25,000, for example. So the land tax kicks in sooner, and it's often actually at a higher margin too.
Yeah, okay. Well, Queensland and South Australia also have a lower threshold for trusts. And while in New South Wales, for particular trusts, there's no threshold. You start paying from $1.
And this is not the only thing that's kind of peculiar about trusts as well. So, we don't just have to worry about the land tax threshold. We're also genuinely paying higher interest rates, especially things like surcharge rates that apply to trusts. So those all have to be factored into the decision.
Yeah, that's exactly right. There is often a surcharge that applies. So if we do a quick example in Victoria, if your taxable land value was $600,000 purchased in your own name, you're looking at a land tax of $2,250 per annum. But if you own in a trust, that's $4,263. And this is because for a property value land value between $300,000 and $600,000, the rates for individuals is $1,350 plus 0.3% of anything greater than $300,000. Whereas trusts, it's $1,901, so already higher, plus a 0.675% amount of 250 for greater than 250,000. So it's lower than kicks in at a lower land value than the 300,000 for individuals, and then the cost and the percentage is higher. This is often the type of detail that someone may not even be aware of when they're setting up a trust to own property, particularly if they've got someone pushing the barrow of owning in a trust structure. They might just neglect to share this information with them. So, even if the property's yields look good on paper, these extra annual costs, along with tax returns, compliance costs, etc., can really eat into your cash flow.
So in other words, trusts might sound like a clever structure at first, but once you layer in the ongoing land tax, the accounting, the compliance fees, you can end up with a strategy that's actually more expensive and not necessarily more efficient, and it doesn't even help your borrowing capacity. And each trust alone is likely to cost you thousands of dollars extra in tax bills. Dave?
Yeah, and in fact, it can often be harder and more expensive to get finance when you have a trust or company structure with higher rates and fees, as we've sort of alluded to. And that's why it's crucial to get this advice before setting up a trust. And this is why it's not just about talking to an accountant. That is, you need to talk to a strategic mortgage broker. You probably, should be talking potentially to a lawyer. You might be talking to your buyer's agent, but you need to get different perspectives is what is probably the most important thing. You might ask ChatGPT and amongst those perspectives as well. But the point is you take all of them with a grain of salt. Okay, you do your own analysis and then you make an informed decision.
Yeah, I reckon that's really well said, Dave. So are there any other tax considerations that investors often miss when they look at using trusts?
Yeah, there's a big one that often gets overlooked, and it's if the trust runs at a loss, meaning the rent doesn't cover all the outgoings, then you can't offset that loss against your personal income, or in effect, you can't negatively gear in a trust. So, that just for our listeners, just so that's really clear, if your rent is less than the interest that you can claim, any lender fees, accounting costs, repairs and maintenance, owner corporation fees, property management fees, land tax, so all the holding costs, and it's
rates
running
and
insurance rates.
That's a lot,
Yeah.
like a lot. And these are generally the things that make a property quite cash flow negative.
Yeah,
Generally,
exactly.
You've got to have a very, very high rental yield for your rent to cover the combined cost of all of these things.
Yeah, look, the way I've always explained, I just call them ownership structures. If you just think about it this way too, as a listener, like every asset has to be owned by something. Now, whatever owns it, it's an ownership structure. Now, that could be a self-managed super fund. It could be a trust. It could be a company. It could be an individual. It can be tenants in common, or etc. Every single one of them has pros and cons. What you want to talk with someone about is what are the pros and what are the cons. Now, a big part of that too is time, because what can be a pro at the start can be a con down the track. And this is something that people don't often consider, because at the start, negatively geared might be great, but one day you want it to be positively geared. So you actually have to factor in the pros and the cons, but what does it look like at day one? And what does it look like if you're holding it 20, 30 years down the track? What does it look like if you sell it? Because, there might be some pros that are helpful at the start, but then you pay more capital gains tax when you sell it. Okay, so it is never black and white. It is never one-dimensional when it comes to ownership structures.
It's a good breakdown.
I love it. To be fair, though, there are situations where this approach makes sense. Can you give us an insight into a couple of these cases, Dave?
Yeah, so, if you're buying high-yielding properties, then, that might make sense to own in a trust structure. If you're adding real value through renovation or development, so the property's income and equity, in theory, might be growing faster than the average. I mean, if you already have equity inside of a trust structure that then you can use, and positive income that's already there, then that might make sense. Look, the most common one is if you're earning a really high personal income, and often, through because you're a business owner, then that's where it makes more sense to own in these types of structures. So, the lender is ultimately relying on the strength of your primary business income to gain confidence in the loans held against each trust. In these cases, the trust structure is often used as much for asset protection purposes, given the risks of running a business, as it is for any potential borrowing capacity, or income distribution advantages. So, even then, the experience is usually very similar to owning property in your own name in terms of boosting serviceability. Because, as we know, generally property is a slow burn. So you're looking at a 3 to 5 year cycle between each purchase as equity and cash flow catch up. Generally, look, of course, there's people out there who can afford to buy 20 properties in one a year, but they're few and far between. They really are very rare. So unless you already have a very high personal income with plenty of borrowing capacity, or your income is growing rapidly, or either personally or through a strong business, it's you really want to weigh up the pros and cons very closely.
You don't really hear those nuances from the spruikers, right? They just market it as a fast track way to grow a portfolio, but in practice, it's a long game. And then this really only works as if you've got the actual money to buy with a low LVR. It's a positively geared property. You close that box, and then you're able to go again. But it still relies on your serviceability, right? So you've got to have the income, the equity, the patience, and as we keep saying, it's not necessarily better than owning in your personal name once you factor in the extra costs with compliance and the tax returns and the cost of setting up the trust itself and the higher costs of interest rates that often come with trust lendings compared to buying in your personal name.
Yeah, exactly.
And Dave, I loved your list, and you talked through, the reasons why, or the situations where it could make sense. And you said if you're buying high yielding properties, but they really have to be very, very high. Because if we think about, regional NT, for example, if you find a property that's yielding you 6% gross rental yield, it's still not going to cut it. Not when we factor in all of the other things. So you're finding a 7%er or an 8%er. That's where we're talking right now with interest rates where they're at. Back in, COVID, post-COVID times, and we've done this study on the ATO negative gearing claims with you previously, Mike. That was a year where there wasn't a lot of negative gearing on offer because we had 2% interest rates. But those days are gone. So if you're sitting on a 5 or a 6% interest rate, you need a lot higher for your gross rental yield in order to cover, your maintenance, your rates, your insurances, your property management fees, and your mortgage repayments. You need a lot more. So I think that if that's your motivation for having a trust because you think you can find high yielding properties, you're missing the point of all of the other downsides that we've just talked about.
Well, the good news is, Cate, according to our last October monthly update, regional NT is yielding at 7.9%. But if you're purchasing with even, like, say, an 80% LVR, you factor in the trust costs, the higher interest costs, repairs and maintenance, property management, all that sort of stuff. I don't think you're going to get a positively geared property out of the box.
And let's talk about that 80% because a lot of people will grab that in equity from another trust, which may or may not be an easy or achievable strategy for them, depending on the borrowing capacity associated with Trust A when you're looking at Trust B. But let's say you can get your 20% out of Trust A and move into Trust B. You've still got to pay for that. Equity doesn't mean free money. It just means that you've got available credit there.
And that could actually push Trust A back into negative, right? Which is
exactly
the whole purpose.
100%.
Yeah. And what we have to remember about properties that aren't generating a strong capital gain, and I'm not suggesting that this is a perfect theory because people will argue with me that Darwin's been doing really well and the yields are better in Darwin, but generally speaking, when you've got a really high yielding, rental yielding property, it might not be giving you that capital growth performance. And what we do know is that rental growth and capital growth generally move at a similar amount over the long term. So if you're getting, 5% capital growth, you should be getting close to 5% rental growth over time. They might be out of sync during their growth periods. You might have, I always say it's a bit like a DNA strand, but generally speaking, our gross rental yields only oscillate between a pretty tight band. So that infers that if you've got a high capital growth property, you can anticipate high rental growth over the long term. So if you've got a high rental yield property in your portfolio and you're wondering why there's not much rental growth, well, that's why. And it will really impact things. If you're not getting growth and you're not getting rental growth, there's a limit to how much equity you can keep grabbing out of that pie before it's running in the red. Okay, second last question. Let's play devil's advocate. I love being devil's advocate. Dave, what are the genuine benefits of using trusts in property investment?
Yeah, so look, primary benefits of using a trust in property investment, one is asset protection purposes, so separating personal assets from investment liabilities. Now, you could use the phrase portfolio structure, but ultimately that's often still linked to asset protection, again, with holding each property in a separate trust or company, which at least ring fences the risk. So if one asset runs into financial trouble, it doesn't directly affect the others. Benefit is tax flexibility, so having discretionary trusts or unit trusts where you can distribute income among different family members to optimize tax benefits.
Yep.
Certainly, estate planning can play a role. It might make it easy to pass on control without triggering capital gains tax or stamp duties. You might be fortunate enough to have a trust that has had capital losses over time. So if you then own assets inside of that trust, you potentially can then sell them and offset those losses against the capital gains in the future when you sell any assets. So there is some benefits of owning within a trust and how a trust can be a valuable tool. But, the core point is that it's not going to magically boost borrowing capacity.
Yeah, you're absolutely right. So it's more about structure and protection. It's not about serviceability.
Yeah.
So last question, when we're balancing all of that out, what are the downsides and risks that people often overlook?
So look, to summarise a lot of what we've already talked about, there's limited borrowing advantage. If any, lenders still count all your debts under your personal guarantee. So it's all factored into your gross borrowing capacity. Refinancing complexity, major lenders often shy away from multi-trust portfolios. They usually will want to see every entity's financials. There's generally going to be higher interest rates and fees, guarantor fees, legal fees with each loan, sets of loans that you put in place. I mean, many trust-friendly lenders will charge, close to 1 to 1.5% more than mainstream banks, and have higher lending fees to set up. So they might offer a bit more flexibility around policy, but you'll pay a price for that.
Yeah. And do you find with some of your clients, Dave, who are opting for trusts and guarantor setups that they need to get independent legal advice?
Yeah, that's happening more and more.
I found
you
that
need
too.
to, and so there's another
cost.
$500, $750 often per trust, per borrower.
And per borrower, yeah.
Yeah. And there's also a timing factor to keep in mind. Equity accumulation and refinancing opportunities usually take years, not months, in terms of obviously the growth value in the property. And because this strategy relies on high-yielding, self-sustaining properties, assuming you're not relying on a very high personal income or rapid income growth, that's a big trade-off. But it's exactly the same as if you're buying in your own personal name. It's not different because the ownership structure, and I really like to demystify ownership structures. It's just another name of who or what owns an asset. It really doesn't, which will have different pros and cons to often the tax, the way it's looked at from a tax perspective or income distribution, but it's just a different ownership structure. You just need to understand what that means with that ownership structure. How does the tax laws change, and what are the pros and cons from that? That's how you need to break it down when you're looking to own assets in different ownership structures. But almost always it's not going to help your borrowing capacity. High yielding properties tend to deliver slower capital growth, as Kate's talked about, often, and are often in lower socioeconomic areas, which is why yields are often high also, but the value growth has often been lower. So they can come with greater landlord headaches. All of that means equity builds even more slowly than many investors expect.
And let's take a minute to circle back onto the cost side, which we referenced before. So we talked about legal and tax setup, ongoing costs, and just as a bit of a ballpark, you're looking at least $1,500 to $3,000 to set up a trust, and then probably around $1,000 a year in just basically the accounting for that trust, depending on the complexity. Of course, we talked about land tax. So some states like Victoria, Queensland, New South Wales and SA, trusts don't get the usual threshold. So that needs to be factored in because land tax will kick in earlier and you'll pay higher rates. And then the personal tax implications. So owning a property in your own name, you can claim that negative gearing to offset your income. But with the trust, it behaves differently. As Dave mentioned, it sort of gets cauterized and sits there in the trust ready to offset a future capital gain, but you can't use it on a yearly basis to minimize the income coming in.
Until it gets cash flow positive, and then those losses can be offset against the cash flow positive income down, but that might who knows when that's going to happen.
Yeah, no, well stated. That's a great wrap on today's ep, and big thanks to Jeromy for such a thoughtful question, and it's exactly the kind of myth we love to unpack here on the Property Trio. If you've been considering using a trust structure, make sure you get legal, tax and lending advice from a strategic mortgage broker like those in Dave's team before diving in. Sorry, I'm going to say that again, Jamie. If you've been considering using a trust structure, make sure you get legal advice and tax advice. And I think a really important one is lending advice from a strategic mortgage broker like those in Dave's team before you're diving in, because while the idea might sound clever, the execution can be costly if you don't understand the full picture or if you're doing it for the wrong reasons. But don't go anywhere just yet. Our gold nuggets are coming up.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is the way that these things can find their way into marketing. Often they're based on some truths. So yes, trusts can be set up as separate positive cash flow entities that don't necessarily get considered, and you can stack them on top of each other. But as hopefully we have elucidated, there's a lot of nuances to it. Firstly, getting something to be positively geared in the first place is not as easy as it sounds. And maybe you can do that over time and it puts you in that position. But I just mentioned the word time. This is not a get-rich-quick scheme to just go, I want to build a $10 million portfolio in the next 6 months and I'm just going to do it by setting up a billion different trusts. There's a lot of things to consider and you should get professional advice before you're looking at it.
Look, from my experience, and that is now over 25 years in mortgage broking, I'm not getting any younger. It's extremely difficult to manufacture borrowing capacity through clever structuring, if not impossible. Lenders look through the entities and they assess you. So, look, a great strategic mortgage broker will find ways to maximize your borrowing capacity, but that's through their skills and expertise of assessing your income goals and matching those to the right lender policy. Trust can absolutely play a role in your strategy, but they're primarily a legal, estate planning and tax tool, not a borrowing hack. And for anyone listening who's tempted by those unlimited borrowing claims online, just remember, the people promoting that idea are usually selling something. So from my experience, they're the ones setting up the trusts, earning fees on the legal work, charging the ongoing compliance and tax costs, receiving income from writing the loans, and packaging this all in, all in one option to work with them and everyone else in that group. So they're all singing from the same song sheet. So, and, they also are often working with the developer who's selling the property that they're trying to get you to buy and earning kickbacks from that. So it's really important to seek independent advice and not just from the person selling the idea. So, and a good strategic mortgage broker can always help you understand what's genuinely possible when it comes to borrowing and lending mortgage broking strategy.
So well said, Dave. My golden nugget covers a little bit of what you said, and that is if you're using this as a hack to get around lending borrowing capacity constraints, I'm really worried. And the reason I say that is we know that the banks buffer it, and there are plenty of people that would say my maximum borrowing capacity would be a walk in the park, and I know I could go higher, but I'm resenting this buffer that I've got to be dealing with. But we all know, the three of us certainly, that there are a lot of lending policies and a lot of products out there, and a strategic mortgage broker will have so many products at their fingertips you couldn't even count them. I mean, Dave, just off the top of your head, what sort of lending panel are your team dealing with?
Well, it's 40, 50 or 50 lenders, plus multiple products. Yeah, there's all different policies. So
there are. So when you think even 30 lenders and let's say 8 loan products across each lender, that's over 200 products that are available. And from any given month and any time, there's always specials and opportunities for different kinds of borrowers, whether they are, self-employed or someone with an overall LVR level at a certain amount. There's so many deals going, and there are lots of lenders out there, second-tier lenders, all kinds that will not bend the rules, but be a little bit more easygoing on borrowing capacity than others. So my thinking is, if one of those can't work for you, if you've had a strategic mortgage broker look over 200 or 300 products and none of them work for you because your borrowing capacity is hitting its rev limiter, I would be really cautious about trying to go the back door way and borrow more when every single lender is saying that you're not good for it.
Yeah, it's like we look at those constraints that lenders have to keep the loan reasonable as just an impediment rather than something that's put in place by the
it's a guardrail, isn't it?
Prudential Regulation Authority to keep you safe.
And look, the reality is nowadays with the breadth of our lending market, if the non-banks don't have to meet those regulations. So as Cate alluded to, there are second, third tier lenders, whatever you want to call them, non-conforming lenders who can be much more flexible. And if they can't even lend you the money, then you probably should be second guessing.
There's a message from above. Well, that was an awesome ep, Dave. Thank you.
And
that was good fun.
Can I take a moment at the back end of this to thank the people that have pre-registered for our live recording, which is going to be in the sunny state of Victoria in the new year. The date's going to be announced really, really soon. We're just organising a few different things, and it'll be a limited event. So please, if you haven't pre-registered, those are the people that are getting the first dib at the tickets. So those that form will be in the show notes. So jump in there. We would love to see you, and it's going to be a hell of a lot of fun.
And I'll pop it on socials as well. Yes, so thanks to those who have registered. Now, I think, guys, more than half of our seats are gone. So that's been amazing considering we haven't given the firm date, and the date is going to be in late Feb. We just have to come out with the exact evening. We're just talking to the venue now, but I'll make sure I pop it on socials as well. So if you're following us on Instagram or Facebook, you'll see it there too. And it's in our show notes on our website, propertytrio.com.au.
And a live podcast recording. What
Can't
could go
wait. Yeah, a few wines. It's going to be so much fun.
Cheers,
Not
guys.
until after the recording, I think.
No way. I'm getting you guys a wine before we go live.
Cool.
Well, I look forward to seeing you next week.
See you guys.
Have a great week.
See ya.